If you are thinking about buying a house, this video is going to give you the tools to know whether an FHA loan or a conventional loan is the right fit for you. I'm also going to talk about FHA loans and how veterans can take advantage of this amazing opportunity. Welcome back to all my subscribers who have been helping grow this channel. If we haven't met, my name is Yeri, and this is where I document my real estate investing journey, personal finance, and my path to financial freedom through real estate. Today, we're going to talk about the differences between an FHA loan and a conventional loan, and which one is the best fit for you based on your situation. And before moving forward, do not forget to show some love to this channel by liking the video, commenting, subscribing if you haven't, and of course, by hitting that notifications bell so you can be notified when the next video drops. Without further ado, let's jump right into it. I should also say that I'm not a loan officer, I'm not a real estate agent, so any of this information, please also go back to your lender and confirm with them that all this information I'm giving you are right, because this information, a lot of the times they vary state to state or time to time, right? When COVID happened, things changed a little bit with conventional loans. So please use this as a guidance, but always go back to your lender and confirm that all this information that I'm providing to you are reliable and are up to date. All right, with that being said, let's jump right into it. What is an FHA loan? If you have any plans of buying a house, you will most likely come across two things: an FHA loan and a conventional loan. And you have a big decision to make whether to use one over the other. So I'm gonna give you some basic facts about the two loans, and hopefully that should help you make a decision on which loan would be best for you. An FHA loan is the kind of loan that's backed by the government, and the reason why that's there is to help you buy a house with looser financial terms. For example, there's 6 different facts about an FHA loan that can make it appealing or a little bit negative, as all the facts about an FHA loan are not positive. One of the best things about using an FHA loan is that it allows you to buy a house with only 3.5% down. Imagine you find a house for 100K, which in this market, very little houses are going for 100K. So I'm just using 100K as an example because it's a very easy number to work with. Imagine you find a house for 100K. Your down payment on this house would be $3,500 and you can become a homeowner. Of course, there's some closing costs and some other costs, and you should always account for that, maybe an extra 2% on the side to account for those costs. But overall, you should be looking at about $3,500 for a down payment. As long as you have a credit score of 580 and above, you should be able to use the 3.5% down. However, if your credit score is between 500 and 579, you will have to come up with 10% as a down payment. Remember, the lower your credit score is, the higher your interest rate is going to be, and the less likely you will be eligible to be approved for the loan. Remember, your credit score defines who you are as a responsible person, whether you pay your bills on time or not. So if your credit score is low, in their eyes, it's basically saying that you have a chance of not paying them their mortgage. So keep that in mind. Which brings me to my next point, interest rate. The higher your credit score is, the better interest rate you will get. Now, one of the downsides of having an FHA loan is something called PMI, private mortgage insurance. So what this basically means is that aside from your mortgage payment, which includes your principal, your interest, your taxes and insurance, you also have to pay something called PMI. PMI is typically 1% of the loan, could be more, could be less. Do not quote me on that. Always confirm with a professional, a lender. But usually, rule of thumb, use 1% as a side note to calculate how much you're gonna pay for PMI, and then divide it by 12, and that will give you your monthly PMI payment, which will also be added into your mortgage payment. But the reason why PMI is there is because you're only coming up with 3.5% down to the bank or to the government, whoever is lending you this loan. You are basically a liability to them, right? You're only coming up with 3.5% down. In case you ever don't make your mortgage payment, this PMI kicks in and basically protects them. So just to summarize what a PMI is, it's just insurance that whoever is lending you this money to buy the house is using to protect themselves in case you default of a payment. Now, these are all the different facts about an FHA loan. On the other hand, we have conventional loan. A conventional loan is basically a loan that is not backed by the government. Instead, it's actually backed by banks, credit unions, and other financial institutions. I've heard of cases where conventional loans allow you to come up with only 3% down, But in my cases, which spoke with different lenders and stuff, the lowest you can come up with was 5%. These kind of terms change time to time because I know when COVID hit, they weren't doing the 5% thing anymore. So like I said, always go back to your lender and confirm with them. A conventional loan is a mortgage that is not backed by the government. As a matter of fact, these kind of loans are actually originated and serviced by banks, credit unions, and financial institutions. There's a lot of similarities between a conventional loan and an FHA loan. And just to give you some perspective, they might allow you to buy a house with only 3% down. So imagine you buy a house for 100K, your down payment would only be $3,000. However, in my situation, I did not see any lenders lending 3% down to purchase a house using a conventional loan. Things change time to time, but the most common down payment, it's usually 5% down. So that would put you at a $5,000 down payment on an $100,000 house. Credit scores are also a little bit different. FHA loans are usually a little bit more flexible when it comes to credit scores, while conventional loans, they typically want to see a 680 or 660 and above. But if you have anywhere between a 620 and above, they might also take you up on that. But always remember that the lower your credit score is, the higher your interest payment is going to be as well. And of course, you also have PMI with conventional loans. The only difference between an FHA loan and a conventional loan when it comes to PMI is that PMI is automatically taken off out of a conventional loan once it hits 20% equity or 80 to 20 loan to value, while in an FHA loan, you basically have PMI for the length of the loan. So if you do a loan for 15 years, then you have it for 15, or 30, then you have it for 30. And to explain this with numbers to make it a little bit easier, imagine you buy a house worth 100K, you put down 3% or 5%, which is $5,000. Your loan would then be $95,000. Let's say in 5 years, you're able to pay down $15,000. So from $95,000 to $80,000. This will put you at an 80-20 margin. So you owe 80% and you have 20% equity in the deal. And this would allow you to get rid of PMI. But like I said, on an FHA loan, you are not allowed to do that. The best strategy to do on an FHA loan is that you then have to refinance your house and change it into a conventional loan. And last but not least, if you are a former or current US service member, then you can take advantage of a VA loan or Veteran Affairs loan. This loan allows you to buy a house with literally no down payment and no PMI. But like I said, these loans are only for US service members. And one thing that I was really forgetting, which makes an FHA loan really appealing, is that the government have things called down payment assistance. So what this is because they want to help people become homeowners. They also want to help you on the down payment of the house, because not a lot of people can come up with the 3.5% down, especially if you are in a market that's really expensive. So different states have down payment assistance. In the state that I live in, which is Rhode Island, they have different down payment assistance. One of them that I'm very familiar with is a down payment assistance of $10,000. This $10,000 goes towards your down payment, and you only have to pay that money back if you either sell, refinance, or move out of the property. So for people that want to become homeowners, this could be really, really appealing because they can leverage $10,000 at literally 0% interest, and you only have to give it back once you sell, refinance, or possibly move out of the property. Don't quote me on that, so please always go back to your lenders, your professionals, and confirm this information. But honestly, this information, it's really hard not to take advantage of, especially when it's literally free money that you can leverage. With that being said, which one do you think is the best fit for you? For me, I think an FHA loan would be the best fit because it allows me to buy a house with as little money as possible out of pocket. Now, even though I said an FHA loan might be the best fit for me, doesn't necessarily mean that it might be the best fit for you. So please do your research. Please talk to your lenders. Please talk to people that know about this. Run both scenarios with both numbers. Run both scenarios and see which one might be the best fit for you. Now, based on all of this information, please let me know in the comments below which one you think it might be the best fit for you, whether an FHA loan or a conventional loan.